Hello and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you joined us for our oil and gas conference. Our next presentation is from Meren Energy. Please note you may submit questions for the presenter in the box to the left of the slides, and you can view a company's availability for one-on-one meetings by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome our next presenter, Shohan Amini. He's the head of investor relations and communications of Meren Energy, which trades on the OTCQX best market under the symbol MRNFF and on the TSX under the symbol MER. Welcome, Shohan.
Thank you, John. Allow me to kickstart with important housekeeping matter. My presentation today does include forward-looking statements, and these are based on sets of assumptions and estimates that are deemed to be accurate as of today's date. However, as always, there can be no guarantee that actual outcomes will be in line with these forward-looking statements. Please do consult our disclosures with our financial statements that can be found on our website, mereninc.com, or on the Canadian disclosure platform SEDAR+. So, who is Meren Energy? Well, until just a few months ago, we went by the name Africa Oil Corp. And maybe some of those attending this presentation know that the company under that old name. We rebranded the company following the completion of a transformational deal that doubled our reserves and production, and we felt that that was the opportune time to rebrand the company to really demonstrate how far we have come as a company, from a junior explorer to a full cycle energy company that has robust cash flows. As John has already mentioned, we are dual listed on the Toronto Stock Exchange. We also trade on NASDAQ OMX Stockholm. And as already been mentioned, we also are quoted and trade on OTCQX best market. And market cap as of a couple of days ago was around $880 million US. And our year-end 2024 reserve base on a 2P basis was about 100 million barrels of oil equivalent, and most of that is in liquid. So the liquids gas split is 75% to 25%. And most of that comes from conventional reservoirs. I will take you through the assets in due course. As you can see from this slide, we are Africa focused. All of our operations on the west coast of Africa, and all our assets lie offshore. Nigeria is where we have all our reserves and production from, and that is very much the beating heart of the company. I'll take you through those assets in more detail soon. We also have a presence in Equatorial Guinea, where we operate 2 exploration blocks. And we also have a very good position. In fact, I would say a leading position for a listed independent exploration and production company in the emerging and the very exciting Orange Basin. Now, one thing that I'm very proud of as the head of investor relations and communications for the company is our very strong track record of delivering on our promises in terms of returning capital to our shareholders. And since our first dividend distribution in 2022, we have returned $425 million, approximately $245 million through base dividend distributions and share buybacks to our shareholders. This year alone, we have paid through our dividend distribution policy $75 million. So let me take you through our assets in more detail, and starting with Nigeria. On the previous slide, you may have seen that our last reported production is close to 37,000 barrels of oil equivalent per day. But what that number doesn't tell you is that production comes from very large assets. And I think it's easy to justify them as, falling into the category of world-class assets. These are assets that are core to us, but they're also core to our operating partners, and these are Chevron and Total Energies. They're also strategic for Nigeria as a nation. there are 3 of the top 5 fields in the country by production. Now, I think that is an important distinction for us when we compare ourselves to our peer group companies. So we also talk about our production from Nigeria as being advantage high net back. What do we mean by that? Well, we have very high quality reservoirs with low lifting costs. We sell our oil production at premium Brent pricing, and we have a very supportive and favorable fiscal regime in Nigeria. Putting those 2 together, those 3 factors together, gives us high netback production that is very much the linchpin of our company. We have 3 producing assets. It's Agbami, operated by Chevron, Akpo and Egina, operated by Total Energies. And in fact, if you look behind me to my right, there is a photo of one of the floating production platforms, Egina, that we have. You know, all of these 3 fields together, the total capital expenditure before we actually bought our interest in these assets was around $30 billion, more than $30 billion. So these are, you know, just to reiterate that these are truly large-scale, world-class assets operated by experienced and well-resourced operators. I don't want you to go away from this presentation thinking that, well, Meren's assets in Nigeria is about production. That's not the case. We do have growth opportunities in our portfolio in Nigeria. Those include undeveloped assets that can be tied back to the existing infrastructure. And we also have appraisal and exploration opportunities. And by exploration, I mean infrastructure-led close to existing facility. So infrastructure-led exploration. And, you know, those do give us scope in the future for adding to our production base in Nigeria. I think it's important for me to add one other point on the fiscal regime. In fact, Nigeria is the only country that I know of that in the last couple of years has actually, in order to attract international investment, has reduced taxes. So our headline tax rate has gone down from 50% to 30%. We also have a very, what I would say, a very constructive commercial framework. We have production sharing agreements. And through that, we actually have a natural hedge in our production because we are recovering back costs. And if the oil price drops, our entitlement goes up. So there is a natural hedge in our portfolio, which has been good to us. So allow me to move on, and I'm going to take you to the Orange Basin offshore Namibia. This is an emerging basin. It's been getting a lot of interest in the international oil and gas industry. It had been explored for many decades with very little success, but that all changed in early 2022 when Shell discovered the Graph light oil discovery. We have an interest, and as you can see, the red envelope there that encloses the blocks 2912 and 2913B, the Venus discovery. And we have an interest in this license, in the Venus discovery, through our shareholding, major shareholding in a private UK company called Impact Oil and Gas. This discovery was also made in early 2022, and it does provide us with significant production expected in 2030 and beyond. This project, the Venus project, is operated by Total Energies, and other partners include Qatar Energy, the state-owned Qatari state-owned company. This is a truly world-class project. It is deep water, and where we are with this, the field is fully appraised, and the operator has guided that the first FPSO, so the first phase of development, is being designed to produce 160,000 barrels of oil per day. Net, we have around 4% interest in this. A very important point here is that impacts and our interest in this project is fully funded to first production through a deal that we did with the operator Total Energies and Qatar Energy, and I'll give you a bit more detail on that later, but that's very important. So there is no upfront cost to us, and there is no strain on our balance sheet, because this is another multi-billion-dollar project. Also, other than the Venus discovery itself, we do have exploration, ongoing exploration on this block. And that is also covered by this deal that we've done. So any expenditure on future exploration wells is also covered through the deal that we've done with Total Energies. Now, what is interesting about the Orange Basin is that geologically, most of it actually lies offshore South Africa. And the map on this slide is basically shows the extent of that fairway. And we do have interest, a direct 18% interest in Block 3B4B. This block is covered in 3D seismic, and we have drill-ready prospects. We're actually the operator of this block. And last year, we closed the deal with Total Energies and Qatar Energy, whereby we transferred the operatorship to Total Energies, and we've got a deal through which we get an exploration carry. I think that was a big endorsement of the prospectivity of this block, because Total Energy and Qatar Energy obviously have significant geological insight from the activities to the north in Namibia. So for them to come into this block was a big endorsement of the prospectivity and what we've done as a previous exploration operator. And we do see prospects identifying 3D seismic that are on trend with the Venus discovery to the northwest. Look, 18% is a significant material interest. And let's say if we make a discovery which is similar size to Venus, that would be transformational for Meren. We do have an authorization from the South African regulator to drill up to 5 wells. We are going, we are still in that sort of permitting appeals process. So I can't give you a definitive date to when this could be drilled, although the operator expects to drill Nyla, a prospect to the north of the block, as soon as all the permits and appeals process are done and we have the final go-ahead. Again, I think the important point here is that we do have significant upside, transformational upside, but we have limited upfront exposure and we are not stretching our balance sheet. So let's move to Equatorial Guinea, where we operate 2 exploration blocks. And we have 80% operated interest in each, and the 2 blocks present 2 very different opportunities here. EG31 to the north is shallow water. It is in a proven petroleum basin with oil and gas fields all around us. It's shallow water. It's in close proximity to offshore gas facilities and an LNG plant, which is now operated by ConocoPhillips after they acquired Marathon. And we are in EG31 for its gas prospectivity. We have 1 gas discovery on the block called Gardenia, which is a good appraisal candidate, and we also have multi-TCF exploration prospects. To the south, we have EG18, which is more similar to what we have in the Orange Basin offshore Namibia and South Africa. It is deep water, and we are in this block for its oil prospectivity, and we have identified large fan prospects. We are going through a farm down process for both blocks. We've had good interest, and we are continuing discussions with the interested parties. And if we are successful in doing the right deal and bringing in the right partners, there is potential to drill on these blocks in late 2026 and 2027. And again, we have opportunities of a scale that could be transformational for the company in case of appraisal, exploration, and subsequently development success. Now, we are doing a farm down, and I think an important point here to note here is that we have 80% in each block. So it gives us significant interest now to do deals and still retain a material interest in these blocks. But ultimately, what we need to do is risk the shares and the costs. Ideally, we get a carry so that we have limited capital exposure to appraisal and exploration on these. So I've taken you through our main asset base, and I just want to highlight our funded growth catalysts. And the two important points here. One is that we have organic growth opportunities in our portfolio. And they're funded either from cash flow from operations, and that's Nigeria. So I talked about near-field exploration opportunities, for example. That is funded from our cash flow from operations. And it's really about our deal making because, you know, we are pragmatic. We don't fall in love with our assets. What we want to do is to have the outlook, to have the prospects, the future prospects to add to our production. So we are doing exploration, we are doing appraisal, and there is development, but we do not want to stress our balance sheet. So we've done the right deals in that we get carries, we get the right industry partners to take us forward. So what do we have in Nigeria? We have the development and near-field exploration opportunities. One example is the Preowei oil discovery, which lies to the north of Egina, and that could be tied back. That is currently being optimized. And we also have Akpo Far East prospects, which is expected and could potentially be drilled next year. And that is on a gross field basis, is targeting around 145 million barrels of oil equivalent, which net to us could be around 50 to 20 million barrels of oil equivalent. Again, considering our reserve base of 100, that is a significant target to go after. In Namibia, I've talked about the Venus development. And again, let me reiterate, our balance sheet is not at risk. There is no upfront cost to us, that is fully funded. And in Equatorial Guinea, I've taken you through EG31 and EG18 and presented our strategy of doing a farm down and get the right partner to take that forward. And we do have significant ongoing exploration opportunities set in the Orange Basin, both offshore South Africa and Namibia. But again, what I want to highlight is that we do have a opportunity-rich, well, organic growth opportunities, and they are funded. On that note, I'm going to take you through the highlights, year-to-date highlights. As I mentioned earlier, we did this corporate deal that doubled our reserves and production. So what was that deal about? We had 50% of a joint venture company called Prime that held the Nigerian assets. So earlier this year, we consolidated 100% of Prime into Meren. We doubled reserves and production, and the other shareholder that owned the other 50%, most of the other 50%, a Brazilian bank, BTG Pactual, they, in return of giving us their 50%, have become a strategic anchor shareholder at Meren corporate level. So they now hold 35.5% of Meren's shares. And they did that deal because they see us as the right vehicle for future growth. And you can see our end of second quarter 2025 results on this. I'm not going to go into too much detail. What are the highlights on this slide? One is we've got significant cash. We have reported significant cash position. And we have, in my opinion, maybe you're even, you could argue we're under-levered. You know, we've got a net debt to EBITDA of 0.6 times. Another important takeaway from this slide is that our cash flow from operations are significantly above our capital expenditure requirements. So what does that mean? That means, well, we have optionality in paying down debt and in giving back to our shareholders in terms of dividends. And we've been very active on both fronts. So we have significantly paid down debt year to date following the completion of the Prime deal. And as I've already mentioned, we returned $75 million to our shareholders through the base dividend policy. I think it's very important to take you through our capital allocation framework. It is very important for us is to defend our balance sheet. That means maintaining minimum liquidity, and we're targeting around 150 million. That doesn't mean holding cash of 150 million. That means a combination of cash, receivables, and so on. We want to maintain net debt to EBITDA 1x. As you've already seen, we are significantly below that. We want to continue returning to our shareholders. So we have committed to an annual distribution of $100 million. And we have organic growth opportunities, right? And we will manage the business, the cash flow, but it's important to make sure that we deliver those organic growth opportunities. Again, they're either funded from cash flow from operations or the industry deals that we've done, we have the carries. So we're a well-balanced company, and I think it's something that we can also consider in the future in a very disciplined manner is, well, are there inorganic growth opportunities? Are they good assets that we could target? And the very important point there is that we are very much focused on producing assets. So we're not going to go and spend a lot of money on a new exploration block and do exploration on our own balance sheet. No, it's got to be accretive on NAV per share and cash flow per share. And of course, strategically, it's got to be sound. So let me conclude on this slide. Hopefully giving you a flavor for the company. This is very much an introduction to the company, but hopefully through what I've said, there is an appreciation that we are a well-balanced company. We have a solid business in Nigeria that gives us high netback production from world-class assets. And, our partners demonstrate that. We've got Chevron, Total Energies. So we've got tier one operators there. We've got funded organic opportunities that underpin our long-term production and cash flow outlook. We have a robust balance sheet. And together, we have been able to deliver on our promise to our shareholders, and we have a transparent and we have committed to a shareholder returns policy. And in a very disciplined manner, we may look at new growth opportunities, new business legs, but in a very disciplined manner, because we've got a very good business and we don't want to risk that. So I will stop there, and I think we have about 8 minutes to look at questions. On this final slide, you have my contact details. Please reach out. We're delighted to provide more information. So going to the Q&A list. Okay, any comments as to why Meren has been trading range bound within the 180 level for the past several months? So yes, I think there's a number of factors there that we have to consider. Some of it is, we've had a rebrand. It's from a market communication. We obviously have to do a lot more to get this story out there. I still meet people that I talk about Meren, and they say, well, haven't heard of Meren. I said formerly Africa Oil, and I say, oh yeah, of course. So obviously that is one challenge. I'm not suggesting that the rebrand was a mistake. It wasn't. It was an important thing for us to do. But also we had a very large shareholder. So our former largest shareholder, a private equity-based fund out of London, they basically made the decision to exit all oil and gas investments because of climate change narrative and so on. And their exit was an overhang over us. So look, we've done the reset, we've done the rebranding, and we continue to deliver. And I think this is where the opportunity lies. We have rebooted the story. There is a question about what is the rationale for the enhanced dividend policy and how sustainable is the 100 million annual dividend? Well, I mean, look, I think what we are striving to achieve is to get the right balance between presenting growth opportunities to our shareholders as well as capital returns. I think the sector's had a terrible track record in the past where it just pursued growth at all cost. And we see the consequences of that across many companies now where they've hit difficulties. The 100 million is basically based on our multi-year outlook. We believe that the production base can support that even in a range of oil price scenarios. And of course, with the right combination of the macro, the oil price, for example, and operational delivery, perhaps there could even be more above and beyond that. And we also have a track record of doing share buybacks. So I don't want to basically just talk about dividends. It is possible. And we have done share buybacks under the Canadian normal course issuer bid. Are you considering buybacks again? So this is a follow-on answer to my previous statement. That is actively discussed at the board level, and ultimately that decision lies with the board. But obviously, we need to be disciplined. We need to look forward and take account of many factors, but it is under consideration. Right, there's a lot of questions here, and we've definitely going to fill the remaining 5 minutes. There's a question, would a mix of buybacks and dividends be smarter than 100% dividends? Look, I think I'm very confident in giving one answer when it comes to the debate between share buybacks and dividends, that you're going to end up upsetting someone. Some people really want dividends. Some people really love the idea of buybacks. So in my experience of the last few years when I've been involved with Meren and on this specific topic, there's always someone that's going to be upset. Is it possible to go halfway and do a bit of both? Possibly, but again, we need to do that with very careful consideration. But yeah, look, again, it's one option that I'm not going to take off the table. It needs to be considered. But can I tell you what is the optimal mix? No, I can't. It's something that needs to, again, be debated at the board level. Right. So based on your oil price forecast, what is the anticipated shareholder returns per share for 2026? Well, look, I mean, we are in a very strong financial position, so we don't need to issue shares to raise new equity. That's not even going to be considered. So you could argue that, well, I would put it to you that we are going to have a stable share count. We, as of now, we're confident that we can continue delivering the $100 million in base dividend. That is very important to protect that as of today. So yeah, that is our anticipation of returning that next year as well. Okay, this one looks like a difficult question. There's been some negative headlines regarding oil exploration in South Africa. Do you still think drilling will commence in 2026? Well, look, I believe that the operator of Block 3B/4B, Total Energies, in a public forum some time ago did talk about drilling in 2026. As of now, we don't really want to commit to a specific timeline. I think it's important to take our time. And yes, you're right, there have been some headwinds in South Africa. It's not from the government or the regulator. It's more of the appeals process that goes through the judicial system in South Africa. And there have been some headwinds, so we just need to work our way through that. I am personally confident that there will be drilling in South Africa. But yes, I think it's prudent to assess the risk, the timeline risks around that activity. But as I said, we've always deferred to the operator Total Energies to give guidance on that. And I think as soon as we've got all the permits in place, then yes, we would be looking to drill on Block 3B/4B. Okay, can you speak to how you're de-risking exploration assets in Equatorial Guinea and South Africa, and what are the key milestones for the next 24 months? Well, look, a lot of G&G work has already been done, and that's why we feel confident to do this farm down campaign on both blocks. Ultimately, I think, the measure of our success is whether we are going to attract partners. And we'll see. So yeah, look, the next milestone is, can Meren attract a farm-in partner to its Equatorial Guinean assets. And I'm hoping that over the next few months, we'll be able to provide an update on our efforts on that front. Right, it's just turned 6:30, so I think I'm out of time. There's still a number of questions I haven't answered. So I will get a report of this, and hopefully I will have the contact details to reach out to those who I haven't answered on a one-on-one basis. But listen, thank you so much for your time and for your attention. And you have my contact details. If there are any other questions, please reach out. Thank you.